I once ran a successful practice, paid a great CPA, filed on time every year, and I was still paying taxes like a W-2 employee for the better part of a decade. Not because I was doing anything wrong, but because no one was looking at the full picture. The tax code changed significantly last year, and if your approach hasn't changed with it, it may be worth taking a closer look. Here's what I see constantly. A business owner with real revenue, a solid CPA, filing on time, and is still structured the same way when they first started. Not because their CPA is doing anything wrong, because their CPA's job is to report what happened, not to plan what should happen. I know this because I was that business owner. I was running a growing practice, doing everything right, and no one ever said, "You're a business owner now. It might be worth looking at this differently." That gap between what gets reported and what gets planned is what I now call the TriBox Tax Optimization Blueprint. And in today's video, I'm gonna walk you through the 5 areas where I most often see the gap show up. Real patterns, real numbers, and by the end, you'll likely see whether your setup is coordinated or just a default. At the end, I'll leave you with 7 questions you can screenshot and use to look at your own situation today. Stay with me for that. Let's get into it. Mistake number 1, not revisiting your strategy since the tax code changed. In July of 2025, the One Big Beautiful Bill Act passed and made permanent several provisions that were set to expire. If your tax plan hasn't been touched since then, here's what changed. The qualified business income deduction is now permanent. Whether you capture it fully depends on the decisions about your entity structure, compensation, retirement contributions. That's the coordination piece many owners haven't considered. Section 179, expensing jumped to 2.5 million and 100% bonus depreciation is back permanently. This affects the timing of equipment and vehicle purchases. And the SALT cap increased to $40,000 for joint filers through 2029. If you're in a high tax state, that's worth factoring into your planning. It reverts to $10,000 in 2030. Listen, I don't prepare tax returns. That's your CPA's job. What I do is help make sure the planning decisions that affects how these provisions may apply to you are considered intentionally. Most business owners aren't having that conversation with anyone, which brings me to the first structural error I look at, mistake number 2, an entity structure that hasn't been reviewed. The first thing I look at with every business owner is how they're structured and how they're paying themselves. Not because it's always wrong, because it's always unexamined. I recently reviewed a situation of a dental practice owner, 15 years in the business, strong revenue, great CPA. He was operating as a single member LLC, taxed as a sole proprietor. Every dollar of profit flowing through as ordinary income, every dollar exposed to self-employment tax. Nothing illegal about it, nothing stopping, just never revisited because his CPA's job is to prepare the return, not to question the structure behind it. When we evaluated an S corp election and modeled a salary to distribution split, picture changed completely. With an S corp, you pay yourself a reasonable salary. That gets payroll tax. The remaining distributions don't. Depending on profit levels and other factors, that split alone has the potential to change the self-employment tax picture. He called it a conversation he wished someone raised with him years ago. Here's what most people miss. The salary you set in that structure doesn't just affect your payroll. It directly determines how much you can contribute to certain retirement plans. Set the salary without the full picture, and you may be quietly limiting your retirement plan capacity. Set it with coordination and it becomes the foundation everything else builds from. Entity decisions aren't one-time startup choices. At meaningful revenue levels, they should probably be reviewed. The structure that made sense at year 1 may look very different at the level you're currently operating from today. And that salary point I just made, it's the key to the next mistake. Mistake number 3, a retirement plan that may not reflect your income. I sat down last year with a business owner who'd been diligently contributing to a SEP IRA for over a decade. Consistent, disciplined, thought he was doing everything available to him. When I walked him through what was actually on the table, he said, "Why has no one ever told me this?" Here's what he didn't know. A SEP IRA and a solo 401k both have the same combined contribution ceilings. For 2026, that's $72,000. On the surface, they look the same, but they are not. A SEP only allows employer contributions, 25% of W-2 compensation. To hit $72,000 using a SEP, you need roughly $290,000 in salary. Every dollar of that salary carries payroll tax. Now, a solo 401k works differently. You get a fixed employee deferral of $24,500 regardless of how much profit you generate. Then you stack employer profit sharing on top. Because of that fixed deferral, you can reach that same $72,000 ceiling with roughly $190,000 in salary. And depending on the specific situation, that could mean significantly less salary exposed to payroll tax for the same total contributions. That difference in required salary and the potential payroll tax impact that it comes with is one of the most common planning opportunities I see go unaddressed. A solo 401k also allows for Roth contributions. A SEP does not. For business owners who believe that their tax rate may stay the same or rise, that option can matter. Whether it's the right fit depends on individual circumstances, and it's worth discussing with your CPA and your financial planner. A solo 401k also allows for participant loans. A SEP does not. And structurally, a solo 401k plan pairs more naturally with a cash balance plan for owners who want to explore going beyond $72,000. Not every business owner qualifies or wants to do that, but the options do exist. And if you're 50 years or older, that catch-up contribution adds another $8,000. And at age 60 to 63, you get a super catch-up of $11,250 under the new Secure 2.0 Act. Now, there are deadlines for you to consider. The employee deferrals must be made by December 31st. And then the employer contributions can go in up to your tax filing deadline, and that includes extensions. Now, for a business owner, your retirement plan may be a tax strategy first and a retirement vehicle second. The reality is the plan most owners are in, that was the easy choice, not necessarily the one that reflected where the business actually is. And that's worth exploring. If this has you thinking and you have questions that are better left for conversation than a comment below, there's a link below to set up a 20-minute chat. Now let's keep going. Mistake number 4. Deductions that aren't being flagged. I don't calculate your deductions or file your returns. That's your CPA's role. But there are areas I flag with every client because in my experience, they're often either being missed or not being fully explored. Home office. If you have a dedicated space used exclusively for business, there are 2 calculation methods. The simplified method, that's $5 per square foot, up to 300 square feet, maximum $1,500, or the regular method, which calculates your actual business use percentage of housing costs. For many homeowners, the regular method may produce a larger deduction, but it requires documentation most owners don't have set up. Vehicles. The 2026 standard mileage rate is 72.5 cents per mile, but depending on your vehicle and business use percentage, the actual expense method may be worth discussing with your CPA. The everyday expenses that add up, business phone, internet, software, personal development, business meals, travel, these are legitimate deductions, but they have a required system, a dedicated business card, receipt tracking, a mileage log. Most business owners I work with don't have these systems in place when we first sit down. Getting them set up is one of the first things we do together. And the timing. In a strong income year, it may make sense to accelerate equipment purchases or prepare certain expenses before December 31st. Not buying things you don't need, timing purchases you were already planning so that they land in the year where they have the most impact. My job isn't to calculate your deductions, it's to make sure the planning decisions that affect what may be deductible are being considered before December 31st, not discovered in April. That's the coordination piece. And that brings me to the mistake that makes all the others possible. Mistake number 5. Nobody's looking at the full picture before the year closes. Everything I walked through today, entity structure, compensation design, retirement plan selection, deduction timing, all of these requires one thing most business owners don't have: someone looking at the complete picture before the year ends. Here's a pattern I see constantly. A business owner has a strong year, revenue is up, margins are solid, then sometime around March, their CPA calls with a number that catches them off guard. Not because it's a wrong number, because no one raised it in October when there was still time to explore options. That's not a CPA's failure. CPAs prepare returns. They report what happened. Financial planning is a different discipline. It's about making sure the decisions that affect what your return looks like are being considered while you still have time to act. In practice, that looks like this. In October or November, you sit down with someone who looks at your projected income and walks you through decisions. Should retirement contributions be adjusted? Should equipment purchases be timed differently? Does the compensation structure still make sense? These decisions can only be made while the year's still open. Nobody is quarterbacking the team. Your CPA handles the return, your financial advisors handle your investments, your attorneys handle formation years ago, but nobody is sitting in the middle asking, does this entity structure still make sense at this level? That's the role that I play. I'm a business owner, I'm a certified financial planner. Our planning is built around 3 core pillars, the ones that actually define the name TriBox: cash flow, protection, and investments. In that order, get the first 2 foundations in place, and you can approach investments with more confidence. We don't prepare taxes, we don't draft legal documents, we coordinate, making sure your CPA, your attorney, and everyone else on your team are working from the same picture. We're the quarterback. Most business owners don't have one. That's why the pattern in this video keeps showing up. Not once, but year after year. Now, before I let you go, here's a checklist. Screenshot this. And if more than a couple of those give you pause, it may be worth a conversation. This isn't about finding one trick. It's about whether your financial decisions are still running on default or are intentionally aligned with where your business is today. And if this sparked questions and you want to connect about them, reach out using the link below, set up 20-minute chat. I'm here to help, whether it makes sense for us to talk further or work together or not. I enjoy these conversations and I appreciate you watching. And if you want to go deeper on the retirement side, this next video is the one to watch. And if you don't mind, drop a comment below. Which of these 5 are you going to look into first? I'm John Rojas. I will see you on the next one.